Hi everyone, I'm Toby Turtle, the official mascot of STO Summit Spring 2025. We're excited to share the recorded sessions from the world's leading summit on security tokens and real-world assets. Hey Jason Barraza, over to you.
Thank you, Augustine, for organizing the STO Summit every year and then keeping us included and always bringing in quality speakers and topics, which of course tokenization is affecting everyone around the world in one way or another. I think we can all agree that this is the future of capital markets, and so just glad that we get to facilitate conversations here that will obviously grow the market along the way. Because as advanced as it has been, there's still a lot of work to be done, and I'm really excited to dive into this, especially this topic, which is DeFi meets TradFi. And I think this is really interesting, especially this year as we've seen the convergence happening a little bit more than we have in the past. For a multitude of reasons. But before we dive into any of it, why don't we do some quick introductions? Ivie, I know you just went but for anyone that's joining new for this session, Ivie, if you can repeat your quick, one or two sentence intro, and we'll go on to Jim, Nicolas, and then we can get started.
Thanks, Jason. Yeah, we quickly chatted yesterday. Thanks for having me on this panel. So I'm Ivie. I am with Somma. We do institutional grade Web3 marketing, and I've been in the space for a couple of years, mainly in tokenization marketing, and very happy to be here and to share some marketing perspectives.
Awesome. Thank you. Jim, why don't you go next?
Yeah, hey everybody. Sorry, my name says Alyssa, but I'm Jim Hiltner. I'm the co-founder of Superstate, run business development. Prior to this, I was at Compound, so one of the larger DeFi protocols, helping run the institutional business there. And my background prior to that was doing the whole boring bank stuff for a long time. So excited to be now on this side of the table.
Very nice. Nicolas.
Perfect. I'm Nicolas, just CEO and co-founder at Elevex, and we focus on real estate investment tokenization. So happy to be here.
Fantastic. Real quick for anyone new, for this session is Jason Barraza, COO at Security Token Market, or STM.co. We're the original and largest data repository for tokenized RWAs. We track over $63 billion worth today and always adding more. So anyone that has new tokens, new offerings, please let us know. We'd love to host your offerings and provide some visibility. But diving into it, why don't we set the stage here as it relates to DeFi and TradFi? What would you say the current state of collaboration really is between the two? What's that looking like right now? And do you see it more as a convergence of the two or just in parallel innovation?
Yeah, I'll go ahead and take a step here. So I think it's an evolution that's going to take a long time, and I think Ivie was kind of mentioning that on the prior session here. DeFi really was born almost a decade ago now. I mean, it's been continuing to demonstrate a ton of resilience and has grown to what's now, if I last look at DeFi Llama, about $100 billion, which is below its all-time high, but still a substantial size. And there's many different amazing protocols on borrowing and lending and exchanges and all that. And so I think the best thing that happened to DeFi was actually Terra Luna blowing up, because that was a cascade of a ton of centralized desks that fell apart throughout most of 2022 and demonstrated how resilient DeFi protocols really are. I had a firsthand perspective. I literally joined Compound the day that Terra Luna blew up, not joking. My parents called me and said, "What are you doing? You're going to crypto and everything is falling apart. What's going on?" But it was an amazing time to just demonstrate how great Compound was. You have 24/7 transparent markets that are completely objective based off of the risk parameters that are in the protocol. And, despite an 80-90% drawdown in most assets that, existed on those rails, there's no bad debt on the Compound books. Aave is still here today. Morpho's doing amazing things. Uniswap is still cooking. So is basically every large DeFi protocol that existed. And, what you're seeing is, the ceiling is getting raised, by which, in terms of the types of assets that can trade on DeFi rails, with firms like Superstate and like the panelists here today that are bringing the traditional markets on chain. And the composability of tokens into these systems is definitely going to unlock a ton of different use cases. Now, I say that's great theoretically because we all have drank the Kool-Aid and believe that this is the future. but that doesn't mean that TradFi is quite there yet. And there's a couple of reasons why. And you know, while $100 billion is really impressive, you know, the Nasdaq trades $300 or $400 billion a day, and that's just equities, right? So it is a great number to circle around, but it's also tiny compared to the trillions of dollars of capital markets that move in the traditional space. And so I think that's one thing just to consider, is that, you know, we still are infinitesimally small compared to the traditional markets. The second thing is, you know, compliance is a major challenge. You know, when we were at Compound, we built a business that basically lent money into the protocol and shielded institutions away from lending there directly, because they just were concerned, like, who's borrowing the money on the other side? How do I underwrite a protocol? But they knew a business that was sitting in between them, despite it being centralized. It was a kind of a hybrid between the two, of like taking advantage of DeFi markets, but using a centralized counterparty that had a S&P credit rating. You know, it has a lot of like rubber stamps to go internally if you're a bank or an asset manager or a family office or whatever it is, and go and say, hey, this looks a lot similar to things that I've done in the past. So I think that is kind of the onboarding that's taking place now. You know, over time, I think we believe that, you know, smart contracts and DeFi will certainly revolutionize traditional capital markets, but you know, it's not going to happen in 2025, and, you know, it might be 2035 until you see real legitimate scale. But I think the difference that has happened over the last number of years is that the progression on the traditional institutional side has continued to progress. It has not slowed down or died away, even though there's been, you know, varying degrees of interest from the institutional side. But you see like large asset managers, large banks, you know, collaborating with protocols and with players in the space to, you know, start with pilots. These are sandboxes now, but they're going to reach massive scale once, you know, folks kind of do enough of their homework where they can see it as a part of their day-to-day operations and demonstrate why it's better than the existing infrastructure. So we're getting there, but it is going to be a long journey.
Absolutely. Even when you said Luna, I'm like, wow, what a throwback, especially in crypto years. But it's actually not that far away or before ago, you know, and not to mention, and to your point, you're right, you know, it's still a very nascent industry in terms of where we're at. And again, I think that we're all bullish on terms of the potential of the technology. It's just more so now the execution and getting everyone on board. So there is that. And any other takes before we move on, but any other takes on the current state?
I wanted to add like some more things, because I mean, yeah, I really agree with the fact that the adoption is very slow, which only makes sense. But I realized also there's quite some like resistance around the whole idea of transparency, which is like a big value proposition as part of going on chain. It's all transparent, like public blockchain, all of that, and it's great. But I think it's kind of idealized. But then TradFi is just not really ready for that. You know, I think they build systems that are definitely not built for transparency. So even though ideally it would all be transparent, I think it just like really requires a cultural shift almost from like the TradFi perspective. On top of that, I also realized that sometimes there's a bit of misconception about what it really means if you start using DeFi technology, because sometimes like TradFi folks, they think, okay, it's going to replace everything. It's like super drastic. But I think there's actually quite some solutions out there that are more modular and just built on top and like built with their legacy systems. So it's another thing that sometimes has to be kind of debunked. And then, yeah, all the scams just don't really help with adoption in general. But yeah.
Yeah, it's crazy that we still have some of those today. High profile ones too that we've seen. So with that in mind, you mentioned Ivie, you know, transparency and whatnot. Is that the greatest resistance or misunderstanding, or is there still something else that TradFi needs to understand to be able to implement DeFi a little bit more?
No, I think they understand their value propositions, which are these like greater transparency, more liquidity. I think everyone knows that also in TradFi. It's just a matter of seeing that it really works, being able to adopt it. That is currently still like creating some resistance as well as regulation. I just wanted to point it out because sometimes it's like really like this major value point within Web3, and TradFi folks like it, but then they're just not really ready for it yet.
Makes sense. And Jim, you mentioned earlier too that there's you know, proofs of concept a little bit and whatnot that's taking place. Again, some of these institutions just need to get their hands on the technology and just try it. As weird as it seems for fintechs, right? Because we're very fast moving people. At the end of the day, there's compliance departments that have their own questions. Leadership needs to understand the technology and see how they're going to allocate towards building more, right? And a lot of that, they're going to want to see, what's going to be the return for us? Why are we even considering this? Where can we save money? And can you prove it, right? So that being said, we've seen a variety of proofs of concept. We still do today. There's a lot also that's moving to full production as well. So which is fantastic to see. I think we just saw Apollo and work with like Morpho and Gauntlet. That's a whole vault that's, live. It's people can actually use it. And then you have others that again are a little bit more on the research side of things. So everything in between. I will say the other part to this, the title of this panel is not just DeFi meets TradFi, but unlocking secondary markets with stablecoins and CBDCs. So that's another topic we want to jump in here. Stablecoins are essentially the payment leg of on-chain transactions, right? It's not a wire, it's, on-chain cash. Are permission stables like Circle's USDC the answer to compliance concerns, or is that too centralized to be effective in a DeFi world?
I mean, depending on, how the market structure or the potential rules that are coming out of Congress progress, I think USDC is a fantastic solution. I mean, it's completely transparent in terms of like what it's backed by. It's high quality liquid assets at one of the largest custodians or the largest custodian in the world, managed by the largest asset manager on the planet. And there's a lot of, programmability and utility that they built on top of that I think, gives a lot of investors comfort. I mean, hence the size of USDC is kind of been up and to the right this year, which is fantastic to see. And that's not just for like trading purposes. That's been embedded into, traditional capital markets, into payments, into cross-border. There's been a whole lot of use cases on top of that. I think it is the lifeblood of crypto. And, from an asset management standpoint at Superstate, like we run, 2 different funds. Like we have 750 million in AUM across, one's a money market fund that gives investors exposure to T-bills, and then the other one's a basis trade fund that, trades the spot Bitcoin and ETH versus futures on the other side. And it's interesting from my vantage point because I can see the benefits of stablecoins way better than I think most people really kind of like understand. Where, on one side of the coin, I've got a very traditional settlement structure where I've got like 2 hours during a day where I can put in trades and then I execute them and then I settle them, and it's like bank wires that go back and forth. And while it's as efficient as it can possibly get, it's Monday through Friday except for long weekends. Versus on the other side of the table, on my basis fund, like I can trade with stables and settle that 24/7 with all the desks. And anytime a subscription comes into the fund, we've actually set it up so that automatically that gets swept into earning T-bill rates. And most asset management firms like sit on some cash for a little while until they move it into something that's yielding, because it takes time to do a wire. And so the programmability of that coupled with tokenization, I think is going to change asset management. And there's budding use cases like you described, Jason, where now I can take private credit shares in an Apollo fund and go to Morpho and borrow against it to either get leverage or to be able to get some liquidity against an investment that I'm going to hold for like 7 or 8 years. So there's a lot of that market structure that's being developed that while there are pioneers doing this in like very small use cases, are going to demonstrate the reshaping of capital markets. And from our vantage point, like we're kind of stablecoin agnostic. We also we back a lot of stablecoins as like the reserve manager for like the MakerDAO, like USDS Sky stablecoin, Frax, and a few others. And I think what's been great to see on that end is that while there's a proliferation of stablecoins, a lot of them are actually leaning on some of the infrastructure of tokenized treasuries now to better automate their reserves as well, which I think at some point in time USDC and Tether are going to be doing as well too, because it makes sense to have all of that on chain versus managing some of it off, in my opinion. But yeah, I think it's you could see the correlation between the growth of stablecoins and the growth of DeFi is going to continue to be a very strong indicator of the success of this market.
Very nice. No, I appreciate that. And that's really thoughtful there. Nicolas, I know your platform, you guys are, it looks like Circle is a partner for you guys, Brassica, which was acquired by Bitco. But in terms of stables, it looks like you guys are, kind of focused on real estate. So aside from the payment into an investment using a stable coin, how else can, either stables or non-stables be used in your platform? And how do you see that evolving?
Yeah, so I think just on the previous point, like it doesn't really, I don't think that there's like a clear winner in stablecoins. It also depends like if you want to use a centralized or a centralized stablecoin or a decentralized stablecoin. So, like for example, if I'm using stablecoins, I probably would prefer not to use USDC because, at any moment they could theoretically freeze your tokens and so forth, right? So it's still fairly centralized solution, which is cool for compliance and so forth. But I think like it depends the type of user that you are, and you should offer both or multiple stable coins so people can either, feel comfortable, using something that's maybe a little bit more secure or a little bit more centralized versus somebody who maybe wants to make sure that they're gonna own their stable coins or their assets, and no centralized entity can have a say over that, right? So I think that's always a common discussion that comes up in the crypto space. Obviously, stable coins are great, especially in secondary markets when you want to interact with DeFi. I think the beauty of like blockchain and where we are today is that there's so many DeFi applications that accept stable coins. And so if you're building something on smart contracts in DeFi, whether it's tokenizing real estate or it's a stable coin, etc., it's so integratable with so many other DeFi platforms. So if you want to partner with a DeFi lending platform or you want to partner with 5 or 6 DeFi lending platforms, you can do that super easily. It's all, a lot of us use the same like EVM standard, so it's super easy to deploy and offer those solutions. So I think that that is obviously a big benefit, and it just opens the doors to freedom of you when you own your assets, being able to be like, okay, today I'm using, for example, Elevex platform, but tomorrow I want to take my assets and I want to use Uniswap or I want to use another platform, right? And so just giving that freedom, I think, which you haven't really had in the TradFi side, right? You can't take your stocks off of Robinhood, for example, right? So I think that's a whole new world that TradFi needs to explore. But when you understand the power of it and the benefits of it, I think it becomes something that's really exciting and creates a lot of opportunity.
Can't take your
For
stocks
sure.
off Robinhood yet, but someday you can.
Love that. And earlier we were talking about maybe like failed projects in crypto. There's a lot of volatility, of course, in the space. Ivie, from a marketing standpoint, how do you find it effective to build credibility for stablecoins? Because we see a lot of stablecoin projects being, issued out there. So aside from the blue chip name brand ones, if you will, for those newer projects, how do you approach, risk averse TradFi institutions if that's their goal, and really how do you build up that credibility for new projects?
Yeah, I think it definitely all ties down to the credibility and the trust, especially. We already touched upon it before, but especially because of the critical environment that we're functioning in. And like I would say that the trust is just a little bit broken in TradFi, and we really need to rebuild that. So I think also for stablecoins, just like it would work for other types of Web2 projects, I think to strengthen their marketing effects, I would really take trust as the main building block. Their brand positioning needs to be on point. Their technical, like they need to really be able to communicate how their product works and how it's technologically legit. And if they can then like strengthen this message with like some type of external validation, such as an audit or like certification, that would be really helpful. But I think specifically for stablecoins, I would focus the messaging a lot on the efficiency and the interoperability. Just like Nicolas just said, like you can use stablecoins in so many different DeFi applications. So this is really like the value added that you should focus a lot on, as well as the efficiency, because the settlement times just like reduce so drastically. Like this can really be the message that you can derive a lot of value from. And I think those could be then the main targets focuses for stablecoin projects specifically. And then besides that, the main principles remain. Also, I think Circle does pretty well in terms of like communicating how they go in line with regulation. So I think they do that pretty well. So you could derive some inspiration from their strategy. Yeah, I think that's how I would go about it.
But I think this is all changing like as we speak. Like the fact that we haven't had major hacks or like centralized desk failures, I think has been, you know, a positive. And like, you know, we said at the top of this, Terra Luna was not that long ago. So we're talking about a very recent period of history where we've had, you know, much more credibility being built just by executing. But I think the one signal to me, and I'm very US centric, as you can probably tell, that has helped us as an industry start to develop more credibility is the fact that the SEC is hosting crypto task force roundtables. Like my GC is speaking at one next week, and you know, alongside Superstate, Maple Finance, and like a few other protocols, it's Invesco, Franklin Templeton, BlackRock, Fidelity, you know, NASDAQ, right? Like these are large institutions. And I think, you know, there's going to be a fusion of the, you know, incumbents and the innovators that are going to bring this market to the next level. But that credibility is being built as there's more and more reputable firms that have built amazing technology that demonstrated, you know, high levels of compliance, and that they're proactively trying to work with the regulators and, you know, and with Congress to bring more, you know, rules of the road. And finally, we have an administration that is welcoming those conversations because, you know, 2 years ago when we launched Superstate, we sent out a prospectus, like 150 pages to the SEC and said, we want to do a money market fund that is tokenized. And they were like, you guys are criminals. Like, you guys can't do this. And we're like, no, we're not. Like, here's 150 pages demonstrating why this is legit. And so that conversation is now something that we just refiled, and we're excited to like actually work through the operational, technical, you know, legal compliance restrictions that they have to build products that just use this technology. And, you know, you got to start somewhere, and treasuries are like the most liquid, safest assets on the planet. So if you wrap those in a token and do it in a way that has a legal regulatory structure, you know, do things in the real estate space. I'm sure that Nicolas and his team are doing like other asset classes and exchanges and lending protocols and whatnot. Like this stuff just takes time. And, you know, I think we're at a point now where there's a lot of collaboration on both sides of the aisle, not politically, but in terms of, you know, the technologists and the incumbents that are trying to build together to demonstrate the utility so that we can get to scale. But it'll be like an infinitesimally small progression, I think, for the next like, you know, couple of years until like all of a sudden everything is tokenized. And like that's going to hit an inflection point at some point. And, you know, demonstrating the why and the case studies around all that stuff is, you know, the hard work that has to happen now. And, you know, that'll take some time to develop into, you know, the full market adopting this as the platform for the future.
Totally right. The regulators have to be willing to listen, willing to work with you guys, with all of us, right? The industry, and as well as the demand to show like, hey, like, you know, the institutions at the end of the day, let's be honest, they're the ones that carry the weight here to you know, demand you know, regulatory clarity or say, look guys, we're trying to do this, but we just want to know what the rules are. That's it, you know, let us know. So I think you're right, Jen, there's a ways to go, and on the proofs of concept and even just showing tangible, you know, results, shifting slightly away just to make a point here from stables, but even on fund tokenization, we saw Calistone come out showing, you know, 23% savings on operational efficiencies. And it's like, great, like this is something that you can show to leadership and they'll be like, okay, well, let's learn more. Now we're intrigued. That's material money that we're saving here just on ops. And of course, everything else that comes with it, right? But, you know, a step at a time here. Now, stables, as we were just covering, can be issued by a variety of people or companies. Then you have the opposite end of the spectrum, which is super centralized, which is CBDCs, central bank digital currencies. Essentially, some people might consider them in layman's terms as just, you know, digital version of what we have today, right? Notes, dollar notes. But do they unlock any secondary markets that aren't DeFi, or is everyone focusing on alternative options to CBDCs?
I'm not an expert in CBDCs, so I'll caveat that with, you know, caveat this with that statement is that it depends on the jurisdiction and like the philosophy, I think, of the people and the country in terms of, and maybe the block, in terms of building a CBDC and what are the use cases around that. While stablecoins have a ton of efficiency, I think, there's an element of concern in a lot of circles, using CBDCs in particular. But then there's also a lot of benefits too, potentially, distribution and being able to make the plumbing of an economy much more efficient. But I just, on a personal level, would rather see that come out of the public sector than the private sector.
Just to add to this, like, also not really an expert in CBDC at all. I never worked with any projects related to this, but I would say that I agree that they kind of go contrary to the whole like philosophy of Web3, which is decentralization, right? So in essence, it's kind of like, why are we even doing this? But I would just argue that it could potentially serve as kind of like a bridge for TradFi. If they see that CBDCs can work, I would say like maybe it could just accelerate the trust in a use case for stablecoins as well. It's not ideal, but that's one way that I could see like some positive outcomes from like CBDCs.
Any takes on this, Nicolas? Or
Yeah, I guess just it depends on like your level of trust and know-how in the space. Like if you trust the banking system and you trust your government and your currency, then maybe you feel more confident or better using CBDC. But if you're familiar with managing your own money and maybe more on the crypto space, etc., then obviously you would probably prefer to use stablecoin. So I think it just probably will depend on the type of person you are and how much faith or trust you have in your government or bank.
a case by case basis here, which again also just starts again pointing towards the direction of, well, if there are some but not all, then and we're going to get to this at some point, but fragmentation versus interoperability on the payment side, right? So really interesting. Not to mention, we also see the third option, stablecoin CBDCs, and then tokenized deposits, which again all similar in their own ways, but slightly different. So curious to see where that kind of takes us. Building off of this, guys, so stablecoins, as we all know, they're all tied to the dollar or a dollar, an example, or a euro, whatever the case is. But we're also seeing yield coins. Yield coins meaning, what some people call tokenized treasuries. I try personally, by the way, and I'll just say this aloud right now. I tried to stay away from the word tokenized treasuries because they're not always the actual treasuries being tokenized. They're a fund that invests into treasuries or liquidity fund that invests into treasuries and other. So just want to make that distinction. But yield coins in general, like USTB, being used for collateral, vaults are facilitating on-chain leverage, as we talked about earlier. Other applications that could lead to future, what I believe is going to be risk-on transactions. What does that mean for stablecoins and CBDCs in secondary markets? Or do you guys think that yield coins will essentially then become the new settlement or payment layer?
I think it depends on how regulatory classifications progress. I think one is a stable coin and one is a money market fund in terms of how the securities versus payments world looks at things today. Our view has been, if you're paying interest on something and it's a pooled investment vehicle, then it should be under the SEC jurisdiction, and so that's what we've pursued. That being said, there's a lot of opportunity to use that as a settlement asset to facilitate transactions. And so if you're like a large hedge fund, and which a lot of our clients are, and they're risk off because of the market, and they decide to go from their Bitcoin holdings into cash instead of sitting in USDC where they get paid no yield and maybe lending that out to like a protocol which takes on smart contract risk, having the opportunity to just sit in T-bills and chill is really, really good for them. But then when they want to go back risk on, there's an opportunity for them to settle that trade with USTB directly as well. Now, there's a lot of restrictions on these products today. Again, like going back to the regulatory side, it'll take a while for the regulators to really get their heads around, permitting these types of products to broad retail distribution in the way that we all see the end state of where this all heads. But as soon as that happens, like it could be an alternative for a stablecoin where you're getting paid yield and you basically are just like using that to spend and pay and settle and trade. But the collateral mobility side of it, I think, is really what's more interesting about all this. There's hundreds of billions, if not trillions of dollars that are just sitting as collateral today, which take a while to move. And so being able to wrap these assets in a token that can move 24/7 instantly and, not require as much of a haircut on certain, transactions is going to be, tremendously impactful to just like the overall capital markets. Whether they become stablecoin payment type of products is still TBD, but there's definitely a distinction I think that's being made right now in terms of a line in the sand between the two. And whether it's passing back some of the yield as marketing expenses on a stable coin or it's paying interest, like our view is like you're paying interest on an account and that should be classified in a particular way. And being able to wrap that in a token allows you to do a lot more things than you can with it. And so maybe there's a bifurcated world between one for just cross-border and payments, and then there's another one for being able to do capital markets transactions, whether that's retail or institutional. But it's tremendous that you can actually bring these two together, because if you look at the traditional world, the dollar rails and the securities rails are like two completely different things. But now we have this platform called blockchains that brings them all under one roof, and now they can kind of sing in harmony versus being in two separate systems all the time.
Yeah, and maybe just to add to that, I think that there's already some exciting use cases that have been put out there. For example, securitized with Buildle, they allow you, for example, with Elixir to basically stake, and then your Buildle tokens, and then you mint DUSD, and then you can go and take your DUSD, and you can interact with other DeFi platforms, and you still own those Buildle tokens. And then when you're done interacting, maybe you're playing a higher risk and you want to earn yield on other platforms, so you can like compound your yield. And so, I mean, there's a lot of interesting. I'm not sure I'm completely convinced as like, for example, tokenized real estate replacing a stable coin and as a format of payment, because not everybody wants to accept that as a payment and so forth. But I think the interesting thing is when you actually stake these assets and then you get stable coins and you can earn yield on top of your yield, and you can go risk on, risk off. So that's definitely exciting. I think we're already seeing like really cool use cases around that.
Absolutely. It varies, right, from the use case to use case, of course. The retail has a different need than institutions do on the day-to-day, right? And so that's also something to do, and that's fine. It depends on who you're building for and who your target audience is, as we all know. That's just basic business, right? But with that, of course, we also want to make sure it's all interoperable and can work together for certain scenarios where you are going to start seeing institutions interacting with retail in DeFi. Because in DeFi, you don't really know who you're working with. You're just on the app, you're looking at a wallet address, which I think is really cool. Thinking about the future, and this is something that we kind of touched on earlier, but I want to dive into it. Are we heading towards a unified rails or fragmented ecosystems? Because as we mentioned, there's a bunch of issuers with their own stables. There's everyone that's issuing tokenized, yield coins, stuff like that can be used again on multiple applications. But how do we end up deciding on what do we use, or do we need to decide that? And how does that impact liquidity, of course?
I think it's mostly my personal view on this. So I mean, I'm still pretty young, but like, I just think like in my lifetime, I don't really see it happening that we're going to see a world where like it's basically one big financial interoperable system, because we're always going to have countries, groups, cultures, regulations that will create some type of division, right? So like, if that is all going to be there, I don't really see that we're going to have one financial system that like literally works globally. But I think we could potentially like strive for like standardized interoperability. So I mean, like, standardized messaging protocols between chains, or like liquidity that can flow more easily between ecosystems, and also like regulatory frameworks that would work more hand in hand, even though they're in different places. I think that is definitely something we should aim for. And actually, I had a really interesting chat last week at the Web Summit with Daniel from Circle, and basically we pointed out that like, even though regulation is like developing, it's developing in Europe, it's developing in the US, it's developing in Latam and in Asia. I mean, if they're developing in all of these different places and they become their own system, then we're just moving from one siloed system to a second siloed system. And even though it's already better, but it's, again, it's not really ideally what we want, right? But yeah, I think we have to stay like realistic in this aspect. And I think if we focus on like interoperability as like a, more of a standardized product that we can like, that would work globally, I think that would already help a lot. And from like a marketing perspective, I think, for marketers, it's just really interesting to focus on the idea that interoperability is not just like a technical concern, but it's really like a value added that allows your business to meet your customer where they're at, instead of your customer having to like migrate to new systems or something. So I think if you're a marketer, that's really an interesting angle you can take when talking about interoperability. What do you guys think?
Yeah, I think choice is good, but I also think silos are bad. So, there's definitely a balance between the two. There's the age-old debate of public versus private. I think there's a lot of stuff that's happening kind of, in between the two of those. There's, a lot of discussions around standards, on different types of tokens. You're seeing a lot of like, especially as security tokens become more of a thing, a lot of different ways that people are kind of thinking about going about it, and certain structures, and that might make it challenging for a broad distribution. If you're like an Anchorage or something like that, and you have a bunch of institutional customers that want to custody assets, it's really tough for you to be able to interact with them if they're not somewhat standardized. And so I think we as an industry will continue to progress like different ways to design different features and functions. But the ERC20 was a watershed moment for all of Ethereum, because now there was like this common standard that everybody could use. And that's why DeFi was able to thrive, because then all of a sudden you could throw a bunch of different assets into the same type of protocols and they could just work. So I think that'll happen. Robert, my CEO, talks about that all the time. That'll happen. It's going to take time. But I think there is advantages to having a system that allows people the choice to participate collectively or separately. But it remains to be seen like kind of where the value accrues. I think what's been interesting though is that going back to the Biddle fund that Nicolas was mentioning, they chose to do that on Ethereum, and there was a update to another money market fund, which is going to be built on like a public network as well. So there are large institutions that are saying, hey, there's a lot of value here to this common platform, which is Ethereum or Solana, or you name your favorite blockchain. And so there's going to be a lot of that happening behind the scenes that like a lot of like engineers are going to have to figure out. But from like a business standpoint, that's all going to be abstracted away, and it's going to be kind of irrelevant as long as that there's the ability to kind of go in between different ecosystems and take advantage when you decide to do an action. If the best route to do that is through some way that your compliance team is happy with, then fine, like go execute your transaction in that fashion. And if it means that that's on a private network or in a siloed system, great. If not, then take advantage of the open system that's there.
Yeah, maybe just to add to that as well, I think it's also a big user experience side of things. So for example, if you're using like a centralized exchange like Binance, it's super interoperable. Like I send USDT on Ethereum, and then if I want in 2 seconds, I send it on Binance Smart Chain, Whereas in DeFi, maybe it's a little bit more complicated, but obviously you have bridges and so forth, but you just need to know what you're doing. It's still quite interoperable. It just takes a couple of extra steps. So I think that it will be heavy on like if you're using a very centralized system, then it will be very seamless and smooth. Then when you go to DeFi, it depends a little bit on the user experience and trying to make it less and less steps when you jump between chains switch tokens and so forth. So I think that it's going to be something that will be a challenge for many years ahead. But definitely, I think that keeping it to a handful of chains would be better, because if you're dealing with 100, 200 chains, then it becomes an issue, definitely.
Yeah, well, that's also something for Chainlink and wormholes of the world to kind of try to navigate. And going back to the Biddle example again, not just from a perspective of going on a public chain, but also the fact that, and to your point, Nicholas, earlier on the Elixir D USD, it's like, oh my gosh, like you can keep the security in a very controlled KYC AML environment, take the stablecoin, go DeFi. You want to get out? Just come back out the way you went in. But again, your KYC AML, and kind of separating, bifurcating the two, which I think is really cool and whatnot. So, and again, you never know how that's going to evolve again later on with other plans I know they have, as well as others in the space here. And curious though, just because I know we've been talking a lot about, stable coins, yield coins of the sort, but there also is another theme as we kind of close out the session here. There's more themes growing up the risk curve, like private credit and others. So I know, for example, Superstate, you guys have the USEC, the crypto carry fund. Just curious how you guys see maybe stable coins or yield coins maybe serving maybe as like an onboarding thing, and where you see other institutions or even yourselves going up the risk curve to other products that maybe best fit your use cases. But any takes on that?
Yeah, I think it all depends on demand. We could issue 1,000 different things and nobody would want to buy it. And so I think the evolution from an allocator perspective is going to be really interesting to watch. If I look at my client base, there's been a lot of demand for treasuries just for what we described earlier about just getting the risk-free rate. If you're a hedge fund or a VC fund and you're sitting on dry powder, great. If you're a protocol that has, a bunch of USDC in your treasury and you're not earning anything, but you have working capital, put it into treasuries. That's great. If you're a stablecoin and you want to be able to back yourself with like RWAs and you don't want to do that in a old school bank account, you can use us. That's great. So those are all fantastic options. I think private credit is definitely getting more interesting. It seems like there's demand from the allocator side to diversify away from just the 4% yield that you get in treasuries and look to more diversified credit type of, mid to low single digits type of yield with a liquidity profile that might not be, instant like treasuries can be, but maybe is locked up for a month or a quarter, with the ability then in DeFi to get liquidity out of it earlier. So I do think that that's going to be an area where you'll see some further progress. But crypto loves volatile things. That's just the nature of the market that we're in. And I think what you're going to see is an inflection point soon where there are going to be assets that are going to be originated on chain that don't exist anywhere else in the world. And they're going to be benefiting, investors, both institutional and retail, by, giving them access to non-standardized securities, or like not your typical, like, risk-free type of securities, and, get other things that can take the advantages of being on chain, give you more ability to self-custody and, use them in interesting ways that you can't in your traditional accounts. So I think that evolution is taking place now, and we'll start to see, more things outside of just the like fund and like fixed income world, be, originated on chain in the not too distant future.
Not to mention that 4 to 5% won't always be there. So
Yeah,
lots change.
100%.
Nicolas, Ivie, any thoughts on this, or are we kind of going to close it out for the next session?
Yeah, I'll just maybe some final thoughts on this topic is that yeah, I think it can be a great tool as well for like onboarding traditional investors, because for example with us, if you want to invest in real estate and you're just a traditional investor, then you'll just see that your ownership is like a digital token, right? Like as if you bought Robinhood stock or shares on the platform. And then once you make that initial step and, maybe you paid with card, so it seems like a traditional buying experience, then maybe you see, you know, oh, I can take a loan on this and I can get something called stablecoins. Oh, I can do this. Oh, I can do that. So I think it's just like about making it very simple. The first steps, like creating an account, investing, getting a digital token, right, into your account. And then from there, they can, you know, learn about DeFi, lending, and so forth, anything else you want to educate them on. So I think that that's going to be a really big advantage to bringing traditional or TradFi people into the crypto space as well.
Yeah, absolutely. It's about the education, the hands-on experience, also making it as frictionless as possible. Obviously, I can't wait, for the day I can invest into a piece of real estate using, USTB, BITL, Benji, take your pick, and whatnot, and just have the flexibility to do that. We've seen people already be able to invest with crypto, but if you can use another RWA to invest into an RWA, I feel like that's really cool. Not to mention the receiving end of that payment. Also, it's like, hey, why would you want a wire transfer or even dollars when you can get a yield generating asset? Evie, any closing thoughts as well on your end?
No, just not specifically on this, but just like I like to believe that like we're all, including TradFi, already beyond the educational space because we're all aware what are the benefits. Many people around me and around us are using crypto, but what I've seen from speaking with people from the industry said it's definitely not the case yet. We're actually still in education, even though it's sometimes difficult to realize this. So yeah, this is what marketing people will keep on doing, and then hopefully very soon we can buy RWAs with RWAs. That would be really cool.
Absolutely. And I know, Jim, last time you went around, you addressed the question, but I'll let you get a stab at any closing thoughts as well.
No, appreciate the time, and yeah, excited to see where the space continues to progress.
Phenomenal. Well, I'll pass it back to Augustine. Thank you all for joining us and your insights. Anyone watching, of course, hit up Nicolas, Jim, and Ivie for any questions you may have. I'm open as well. Augustine, back to you.
Thanks for joining us at STO Summit Spring 2025. Stay curious, stay connected, and remember, the future is tokenized.